We'd like to move swiftly on now with upstream adjustment to a new oil price environment. And leading this session as the moderator is Sadad al-Husseini, the president of Husseini Energy. Over to you, Sadad.
I was keen on explaining the title of the conference is Boom, Bust, and Beyond. We don't believe in the bust. We're solving the long-term view on things. But to be clear, we have gone through a very dramatic phase since the OPEC meeting of November 2014. Whether prices collapsed because of a mega cycle of commodities or slowdown in the economy in the Far East or disruptive new technologies or maybe even a miscalculation of OPEC, whatever the reason, we have seen not only a drop of oil prices, but a rise in demand. In fact, in November, the oil volume production was 94 million barrels. Now it's 97 million barrels. In parallel with all of this, the impact of prices has been devastating on the industry. Rigs, often used as an index. I guess everybody follows Baker Hughes' rig count almost as much as they follow NASDAQ. The rig count came down in oil from globally 3,600 rigs to 1,500 rigs currently. In the US, the drop was even more severe, from a peak of 1,600 rigs to just about 420 now. I have a couple of slides I'd like to show you just to set this context. Could we have the first slide? Can you pass me the, yeah, there. So one of the issues that we often talk about is how are we going to fund the industry? These are two surveys that were conducted recently, one by Barclays, one by EIA. And you can see that spending is way down. Now, this is a business that only runs if you put money into it. It's, you know, it's the gasoline of our industry. If you don't invest, you don't get production. But we work in a real-time domain and a lag-time domain. In real time, oil prices go down, you don't see the impact. But in lag time, you see the impact 2-3 years down the line. The impact of these kind of cuts in spending, which mostly started in 2014-15, is now coming upon us. How severe is this issue going to be? Well, this is not rocket science. This is just a simple best fit of two curves. Quarterly demand, as reported by the EIA, and quarterly supply, also by the EIA. Demand has been increasing at 1.5 million barrels on average over this time frame, year after year. Supply has been increasing at only 700,000 barrels year after year. So the crossover is inevitable. Now, it doesn't mean that we will continue to see this imbalance. Prices will have to kick in and restore the balance. We're very fortunate to have with us the three panelists. I think the names are in your program, and they certainly represent an excellent cross-section of the industry. We have John Hess, who's, of course, CEO of Hess Oil, and you all know that. We have my good friend Ali Moshiri from Chevron, and Deborah Byers from Ernst. I'm going to start by asking John the first question. And John, now that you've had a chance to look at these numbers, and with your vast experience, how do you see the terrain in the oil industry at this point in time?
So thank you, and it's an honor to be here. You know, the price floundering between $40 and $50 last year, I'd say, has been devastating. Lower for longer, obviously, really almost the last 2.5 years of these low prices. The industry is still adjusting. But I think the impact of these low prices is threefold. First, on investment. As you said, a lot of gasoline is needed, a lot of investments needed to hold production flat, and we're below that number now. 2 years ago, investment in the oil and gas industry globally was $700 billion. Last year, as most people know, it went to $550 billion, and this year it's $380 billion. And as the IEA points out, you really need to spend about $600 billion to hold oil and gas production flat. So we're way below that now. And I think we're setting the seeds up for some supply shortfalls down the road, according to how short cycle and long cycle sources of supply respond. So the first impact is severely decreased investment. The second impact is that from this severely impact of investment going down, the industry is running chronically huge financial deficits, and they're not sustainable. Even after significantly decreasing investment, as I just talked about, and dividends, the oil and gas industry of public companies is running a deficit last year of about $100 billion, and this year $100 billion. That's not sustainable. And everybody knows OPEC is running a financial deficit of about $500 billion. Not sustainable. So that's the second problem. So first impact, low investment. Too low. Second impact, financial deficits, hemorrhaging, not sustainable. And then the question is, what's the third impact? And that's the financial markets. How have the financial markets reacted to these deficits? And what role are these financial markets playing? And really, we saw the world change in January of this last year. And that's in January when the oil price hit $27 a barrel. It's as if the debt market said no mas. And specifically, you saw that in the high yield market, which was the major engine of funding for the shale independents in the United States. Typically, the high yield market, or junk market as some people call it in debt, funded each quarter 20 to 40 issuances of debt offerings. In the fourth quarter of last year, that 20 or 40 went to one issue. In the first quarter of this year, it went to 0. In the second quarter of this year, it went to 1. And just recently, for the third quarter, it's 3, and they're really on the back of equity issuances. So the point is, the high yield market dried up. That contagion or fear or anxiety in the high yield market spread to the investment credits as well. And the rating agencies that rate credits said that you had to run your company at $30 for 2 years. And as everybody knows, the oil industry doesn't work at $30 for 2 years. So as a consequence, investment grade credits were impacted as well. And that obviously had a chilling effect on the industry. So what happened as a consequence of these seizings of the debt markets? About 90 companies went bankrupt. About a third of the E&P companies in the United States, public companies, went bankrupt. Some issued equity. About $40 billion of equity has been issued over the last 2 years because you couldn't get debt, you had to go to equity. And then on top of it, and that was really to just basically give a lot of companies lifelines and shore up their balance sheets. And the third impact was the bigger companies, the Exxons and the major oil companies of the world went to the debt market because they could. And they issued over the 2 years about $120 billion. So the point here is the financial markets responded in that way, either with equity or with investment credit debt, just to keep your balance sheet to survive the storm. I think one other interesting point, Sadad, is general knowledge says low oil price is good for the stock market. And 2 years ago, that was true. But if you look at this year, there's about an 85% correlation between oil price and the S&P. When the oil price goes up, the S&P goes up. When the oil price goes down, the S&P goes down. My point here is a strong oil price is actually good for the equity markets.
Well, that's a pretty dramatic overview. Ali, let me ask you, let's build on that. If cash is such an issue, liquidity is such an issue, and of course Chevron has been a leader in deep water projects, very costly projects, West Africa and elsewhere, Gulf of Mexico. How do you see this panning out? How do you see this evolving for the major oil companies if they want to continue to develop the resources that we need?
Well, first of all, my experience has been that the demand going to continue to grow, supply going to continue to meet the demand. What we see in this cycle is just a bump on the road. I think everybody's saying we're going to come out of it because there are secondary parameters, as John pointed out, going to impact the production. But the era that we are in right now, in the big company, prioritization of the asset is number one. Because what we're going to do, and what we have done, the number one parameter that we got to work on is your capital spending. You cannot borrow money putting in the substandard project just for sake of producing barrels. It doesn't make sense. We won't do it. It doesn't make sense for anybody, including our shareholders. Therefore, reprioritization is taking place. You're going to see some of the activities, like deep water, that require above $60. Some of them require $80. Development, oil prices support the development. They're going to shift into the future. Focus is going to be on the base business. We're going to basically get enough barrels out of the production of the current assets. Those are the barrels that are going to fall into what the market is looking for. That asking us, you got to run your business between $30 and $45 oil prices. If you look at extra heavy oil in Canada, Venezuela, deep water, I personally believe those are going to be pushed into the future. Wait for the right pricing coming in. Our focus is going to be maturing the current asset that we got. Also, we're going to look for the short cycle projects. The project that you can see, it can work within this price environment. The major capital project, major capital project, I think is going to be very difficult. And if it's justifiable, it's going to be justifiable in the price range that we were talking about, $30 to $45. If it's not, it's going to be pushed into the future. To address what John brought up regarding the borrowing level that IOC is doing it and others are doing it, is cut back on the C&E and be more efficient on C&E. If you are not efficient on C&E and borrowing money, really it's not going to help anyone, especially your shareholders as well as the host government and so forth. Therefore, that's the direction we are seeing.
Deborah, with your background and your deep knowledge of the financial sector, what advice would you give folks who are in the E&P business? How are they going to pull through this bust cycle and get into the long term?
I want to just add on to John Hess's comment. There's been a number of bankruptcies in the United States. As everyone knows, he mentioned 90 bankruptcies. Most of those were all balance sheet corrections because of over leverage with the high yield market driving the leverage. Those companies are still around, and of course they've been through what I'll call sort of a very robotic process of cleaning up their balance sheet. So these companies are still around, and I think that the two things that I would think about is very broadly speaking, we look at the change in the market in investor behavior that's then going to drive behavior for the companies. The investor behavior, they're starting to absorb the fact that this resource may not be a scarce resource. This resource may be an abundant resource, say for the next 50 to 100 years. Now, if you think about an abundant resource versus a scarce resource, what are you going to reward companies for? It's not going to be, you make a great find, deep water, offshore, and all of a sudden your stock price goes crazy. What they're really looking for is sort of the boring things that companies need to do very well, which is around operational excellence, cash flow, balance sheet management, dividend yield. These are the types of things that investors are beginning to reward. Likewise, I think if you're looking at companies talking about short cycle projects, that makes a lot of sense because that's how they're going to get short-term cash flow. Longer term, that pushes out some of these projects, as John talks about. Eventually, if you look at the curve here, and we believe that, we're going to need to develop some of these more longer cycle projects in order to meet global demand. And so how do governments start to think about that? And when I talk about governments, I'm not just talking about sovereign countries. I'm also talking about in the US, states. So you look at the announcement in Alaska. There is a huge find in Alaska, but they're going to have to be thinking about their fiscal regime in a different way. Not in terms of just your typical, we talked about this when we were prepping, rent seeking. So I'm going to increase the physical take when oil prices are high, Levers like taxes and royalties are relatively easy to change through the actions of the government. So instead of just thinking about when resources are now abundant and capital is scarce and capital is very mobile, governments need to start thinking differently about how do you attract that capital, especially if you have much more of the longer cycle projects. If you have stranded gas projects, deep water, a lot of risk, then you're going to need to look at perhaps partnering in a very different way to accomplish the development of those projects in those jurisdictions.
John, let me come back to you. So, given this reality and given the stressed balance sheets that the companies have, and given the importance of both having a long-term view, as you point out, and the short term, how are these companies going to manage this long term? Is shale oil going to be a universal solution where it's going to go all over the world, or how do you deal with that reality?
Sadad, let me try to give some perspective on shale, and just by way of introduction, we're one of the leading oil and gas producers in the Bakken, so we have some experience. About half our company is unconventional, led by the Bakken shale. I think some points about shale. First of all, it is not a swing producer. I often read that in the newspapers that it's the swing producer. It is a short cycle producer. Saudi Arabia, to the best of my knowledge, is the only swing producer out there that can go up or down a couple of 100,000 barrels a day on short order. Shale, on the other hand, from first investment decision to first oil is somewhere between 6 and 12 months before that oil can hit the market. And that contrasts to the longer cycle projects like the deepwater offshore, where Ali's company and ours partner, let's say in the deepwater Gulf of Mexico. That may be 3 to 5 years from the first investment decision. So shale has really carved out new space for itself on the supply side of things. But at the end of the day, when we say short cycle, what are the things that maybe make it not like a light switch, but it takes 6 to 12 months? First of all, like in North Dakota, it takes 3 months to get a permit. The logistical planning is huge. When you have a rig on a site, on a drilling pad, you need hundreds of trucks, somewhere upwards of 500s, to get the rig set up, to get the frac equipment there, and have the water and sand necessary for the hydraulic fracturing. So big logistical undertaking that takes some time, and the planning that goes as part of it. Also, one of the headwinds to shale getting back in business, even though we've added about 100 rigs back from the bottom of the 400 that you talked about in the United States, is people. Hundreds of thousands of people that were working in shale now have gone back to their home states because they can't get jobs in the shale industry. So there's going to be friction as we want them to come back, and then there's going to be a productivity lag because not all these people are going to be as prepared as they need to be low cost and efficient. And I think the other point is the balance sheets that we were talking about. The balance sheets are in disrepair. So you're going to have to rely on your own cash flow, which is going to be a function of price. So going forward, shale's growth is really going to be a function of price. The oil's there. So what's the impact on shale been because of the drop in price? The rig count in the United States, all rigs in the United States, gone from about 1,900 2 years ago to about 500 today. That's not enough to grow production, even though we've added 100 rigs back predominantly in the Permian. The U.S. production from peak is down 1 million barrels a day. So those in OPEC and IEA, the U.S. has made its cut already. It's 1 million barrels a day. We'll see what else the market brings. But at the end of the day, the industry is very resilient. A lot of independence, a lot of entrepreneurial spirit, and really has risen to the occasion of the low price. So as a consequence, our company and others have reduced drilling time from spud to spud for a rig from 30 days 3 years ago to 15 days today. And as a consequence, we've become much more efficient. And that's reflected. The IEA talked last year that it would take $60 to hold shale production flat in the United States. I'd say because of the operating efficiencies and productivity improvements, some of which Andrew was talking about in his earlier comments, the industry now needs $50 to hold shale production flat. Now, we're doing it from a lower base because from peak we're down 1 million barrels a day, but at $50 we see shale pretty much staying flat. And I think the other point to bring out is I don't think the shale recovery, as oil prices improve, will unravel the price recovery. I remember some comments made last year by His Excellency Abdullah al-Badri, can shale and OPEC coexist? And the answer is, of course they can, and they actually need each other. If you think of the world growing, according to some of the numbers that have been talked about in this conference, if oil demand's growing about 1 million barrels a day, and hopefully that's a conservative number each year, you need 10 million barrels a day of new production. And you also need probably another 30 million barrels a day over the next 10 years of new production to make up for the production declines we're going to have. So you're going to need 40 million barrels a day of new production over the next 10 years. How much will shale provide from that? Physically, we think the most that will be is about 5 million barrels a day. So yes, it's short cycle, and yes, at $60, shale may grow 300,000 barrels a day year versus $50 where it's flat. But if you're going to grow 1 million barrels a day and shale's only meeting 300 to 500,000 barrels a day of that, the rest of the oil is going to have to come from other sources. OPEC, longer cycle projects like the Deepwater Gulf. And you're going to need prices in excess of $60. And I agree with Ali, it's probably between $60 and $80 to get the long cycle business working again.
Ali, here's the point. You guys, you write the checks and the service companies have to deliver. And last time I checked, the semis and the floaters, 60% of that fleet is stacked. It's not operating. And I guess the service boats and the terminals and the fabrication yards, they're all probably pretty much idle or releasing people. Do you see that as an issue? Is the service industry prepared to respond?
I think it's not going to be a major issue. It ain't going to impact on what the future oil price is going to be. Some of the service companies, especially deepwater rigs, they really leverage their balance sheet, and they're overdone. A lot of these deepwater rigs right now sitting idle. In any investment, they also service company got to consider it where that investment going to sit on the oil prices. If you want an ultra deepwater rig that you charge $800,000 a day, you got to figure out you need an $80 to $90 oil price to support that. And as I pointed out, it's not a secret. If oil price goes down, the first thing we're going to touch is capital expenditure. And what is going to impact? The higher oil prices activities. It's simple as that. Our business is not very complicated. It's very simple and straightforward. That's the way we adjust ourselves. We've gone through this cycle before. But I want to build up on what John was saying. The phenomena of unconventional is real. I have a different view. Is it what I call the romance is sitting out there. It scared the hell out of a lot of people. What's going to happen if oil price goes to $60? Whether or not Eagle Ford or Permian or other area are going to increase the production. I really do believe they are not showing producer, but they are the first one going to get to their starting line. Because of why? Technology, creativity, initiative, and efficiency. You got to see what's going on there. I agree. The lower the number of the rigs from somewhere over 1,500 rigs down to where we are. That's the only place you can do it. And I assure you, they can ramp it up as fast as they brought it down. Therefore, for time being, this niche resource is going to play a significant role to balance the price for time being. I mean, that if oil price tomorrow goes up to $60, I assure you, you can watch that number of the rigs going up. Whether or not the cycle time is going to take 6 months or 9 months, that's going to have an impact on their stability. But I fully agree with John. What is the maximum capacity of unconventional? The only two play that show and demonstrate that it can work unconventional is United States and Argentina. And Argentina is far down the road to become close to the United States. I agree with John that we're going to reach in that peak production. We're going to run out of the sweet spots. We're going to drill in the areas that the productivity is going to justify, not $40 oil price, $80 oil price. And that's where we're going to see deep water activity come in play. We're going to see heavy oil, extra heavy oil going to come in play. Therefore, this phenomenon of unconventional in short term is the one that kind of put the price, not necessarily getting the balance itself, because you can see the reaction from it. Therefore, that's what I'd like to add to John's comment. On the service sector side of it, I think it has been a tremendous impact on the folks that they leverage the balance sheet, betting on a lot of deep water, ultra deep water activity. I think it's going to push into the future.
Deborah, what oil price is going to kickstart the oil services into recruiting, into laying, equipment, bringing equipment back, buying materials, renewing kit? What oil price do you think, based on your experience, would get the services back on board? There's
probably a lot of people in this room that probably know that a little bit better than I. Any price that I name is going to be wrong, but I'll say this. The service side and the transformation there and the distress there and how they're going to come out of that is a little different than the shale producers. Shale producers, as I said, they're coming out with their balance sheet pretty much cured. They're starting to emerge. And so their next task is going to be to transform their business to operate at a much more efficient, leaner balance sheet. On the services side, there's going to be capacity that just has to take out. Because to your point, there was just massive overbuild. Again, some of that fueled by cheap debt as well as equity. And so that capacity is literally going to go out. So there's going to be companies that simply go out of business, liquidate. And what anecdotally we've heard many of the service providers, especially the floaters, the banks, they don't want to own this rig. So the last thing they're going to do is foreclose on, and suddenly they own $1 billion, drilling rig. What are you going to do with that? So I think a lot of them have kicked the can down the road, say 2 to 3 years, and are hoping for, $60, $70, $80 oil. But to the point about the swing producer, I'm glad you brought this up. I think there's been a lot of, discussion about that. It's not so much a swing producer as the way we're thinking about it, and I think this is what you're saying, is that at least for the short term, so let's say 3 to 5 years, shale from the United States becomes sort of the cap, sort of the ceiling on price. Because as price kind of creeps up towards 55, 60, you see activity like they put on hedges. Now they can push the can down a little bit further and have cash flow to continue to fund drilling. And so you may see a cap or a ceiling on price because of the short cycle, whether it is 6 months. There's a lot of drilled uncompleted wells that'll come in first, and then you can move out to 6 to 12 months to bring on new production. And so I think that's the way I would look at it. So that pushes you out maybe a little longer term for the service sector to really hang on. 2 to 3 years is a long time to hang on with the kind of balance sheets that they have.
I'm sure we got a lot more questions on that point, but I don't want to take over all the time. So can we open the floor now, and then I'm sure there's other issues that we can tackle with the panel. But any questions?
Hi, thank you. Nick Coleman from Platts. The majors have not all necessarily excelled in the US shale space. I wonder what the panel thinks about that, and also about their efforts to help take shale as an industry overseas to places like China or Latin America, which have also not necessarily all been successful. So I'd be interested to hear the panel's comments on that. Thank you.
You want to try first? As an independent, I'll go first, and maybe Ali, as the big major, go following me. On shale, it's different operating model. We're very lucky in the Bakken. We use lean manufacturing. You hear Jack Welch talk about it, but it's really a culture of eliminating waste, finding continuous improvement, and really making a team of problem solvers at the rig floor through the organization. So you solve problems by the people that face the problems as opposed to have it be top down. And I think that's really made a difference in our company, where we've taken rig prices and drilling and complete costs from 3 years ago of being $10 million for a Bakken well to a little under $5 million today. So if you find 1 million barrels for that in your estimated ultimate recovery, you're getting development costs about $5 incrementally for each well that you drill. So, you know, the independents have done a pretty good job of really putting that operating model in. I think some of the majors are making progress in that now, but it's a totally different culture of how you run your company in terms of operating efficiency. So that's point number one, the independent headset for being a low-cost operator in shale. The second point, you know, you asked about why hasn't shale gone global. Our own company, because of what we did in the Bakken, the natural thing was, well, you know, there's got to be other places in the world where we can take this new operating model. And we studied a lot. We actually tried a couple of places, and we really found what was sort of unique in North America wasn't necessarily the case in other parts of the world. And we found there were 5 factors that were key to shale being successful, and in other parts of the world where it was successful in the United States and Canada, it wasn't the case in many other parts of the world. The first is geology. You have to have the right rock to explore. Number 2 is you have to have alignment of ownership, the subsurface ownership with the surface ownership, and in a lot of parts of the world they're misaligned. The third point is, as I talked before, it's a huge logistical undertaking to drill shale wells. It's a lot of people, it's a lot of equipment. It's really almost like an assembly line type of process. And having the infrastructure to support that assembly line is few and far between. In the United States it exists, in Canada it exists. In other countries it doesn't necessarily exist. The fourth element to be successful in shale is fiscal regime. It's a high-cost barrel. It's a high-cost MCF. So you better have a government that realizes it so you can make a return on money. If you have a confiscatory tax regime, it's not going to work. And last but not least is regulatory regime. Obviously in Europe, fracking's been banned. We can get into the merits of that, of whether that's good or bad, but you're certainly not going to go where it's banned. So these 5 elements have to be in place for shale to be successful. The only areas that we've seen that have a chance is what Ali talked about was Argentina. Those elements seem to be in place, but it's early days. We'll see where that goes. Russia, we'll see where that goes, and China, and we'll see where that goes. But a lot of these other countries really aren't in play in terms of shale going global. Ali?
Excellent question. I wish we had 2 hours to talk about the first part of it. You know, if you look at the history, actually independents are the ones set the path for unconventional. Let's give them all the credit. Today, even they are the one that they drive the efficiency. They are the one introducing new technology, new creative way of lowering the cost. We are really fast follower. And if you look at it, the initiative that has taken is really focused on 3 parameters. EUR, estimate ultimate recovery. How much barrels do they get out of each well? IP, initial production. What is the rate and cost? Unconventional is about cash. You're recycling cash. Basically, the cycle time is short, and that's what we talk about it. Unconventional is the one. Oil prices move by $5, rig count's going to go up. Trust me, if you plot oil prices to the rig count, you're going to see parallel line. It's going to go that direction. Therefore, the focus is going to be there on efficiency, efficiency, efficiency. We used to drill wells in Argentina. Cost us about $18 million compared to taking Eagle Ford or Permian, which they right now drilling somewhere about $7-8 million. We managed to lower the costs. The second parameter in unconventional is infrastructure. Infrastructure plays a significant role. The reason unconventional works so well in the States is because infrastructure is there. Trying to mobilize 20 drilling rigs in Argentina, the cycle time would be a year. Trying to mobilize 20 rigs in Permian, it's not going to take a year. It may be much, much shorter period of time. Efficiency, infrastructure is the one drive the unconventional. I really do believe that efficiency is improving every day. Today, some of the independents are working how they can manage to make cash out of the $40 oil prices. It may not be there, But trust me, through the technology, creativity, initiative, and pressure from the market, because they got to borrow the money, they're going to drive that cost down. Right now, they are drilling 2,500 feet horizontal wells, that the cost is almost in par when you put $1 per foot with any efficient type of drilling. I wish we could do that one in the deep water. Therefore, we could develop it much faster and lower cost.
Deborah, did you want to add something? Oh,
well,
sorry.
Let me comment on the second part. The second part, as John pointed out, geology is a driver, no doubt about it. But the most important part of it is the infrastructure. Can you create the infrastructure to get the barrel out? No other places other than the United States we have proven you can do that one in an efficient manner.
I was going to say, you talked about a manufacturing process. It's very different than a process of, drilling 2 deep water wells and, you've got 2 platforms to manage or 1 platform to manage. It is a very manufacturing process. And I think what precedes the ability for, say, a major to do that, I think the path they're choosing is the one that ExxonMobil did when they bought XTO and kept a company within the company. And so you saw last year or the year before, BP did the same thing where they effectively created an internal company. And they called it a spinoff, but it's really a wholly owned subsidiary that's going to focus on this, because you have to change the culture of operation, a completely different operating model. And that company within the company is a way to solve that. It's a fast learner, a fast follower for the major. So I think that revolution will take place.
Let me come back to Ali. Ali, I'm wondering now if, as Deborah says, there's a $50, $60 kind of cap there before oil services get excited. And John tells us you need 10 million barrels roughly, in the next few years. What do you see happening to the deep water and the heavy oil sands and the high latitudes? Are those going to be written off for a while? Are they on the back burner for a while?
That's my personal opinion. I think it's going to be pushed into the future. I think it's silly for me saying those are the projects can justify for this price environment that we are in. And remember, those projects, the cycle time for them is 10 years. I mean, you take a deep water project, it's a 10-year cycle time. And if you can justify it on the flat price with the current environment, I think those are the mega projects that you see. For doing that, that means you've got to find big elephants in the deep water, okay? Average discovery in Gulf of Mexico, deep water, is about 200 million barrels. It's not big. Now, if you find a 1.5 billion barrel resource, then you can ride the cycle of low and high prices. But those are not the size of the resources we find. Where do we find them? In heavy oil and extra heavy oil. And if you look at those projects, those are multi-billion dollars. And the differential in the price would impact you much greater in the low price environment. From the practical point of view, when we look at our portfolio, it's a reality. Certain projects are going to push into the future. And those are what I see is going to be heavy oil, extra heavy oil, deep water, ultra deep water. And we're going to move into the low cycle project. Unconventional, the reason it got the romance is cycle time. Even if it's a year, you can see the cash return very quick.
Yeah, and I think another point, Sadad, just on the long cycle projects, and let's talk about global exploration. The global exploration has gone from $100 billion a year of investment to $40 billion, which means the pipeline of these long cycle projects is not being filled. And I think WoodMac recently did a study that 68 projects that are mega projects have been deferred. About 2/3 of them are deep water projects, deferred or canceled as the case may be until the price signal's there. I think this is going to build up a supply shortfall somewhere between 2018 and 2020, where the short cycle will play its role in filling the short-term needs of the oil market and oil supply, but then the market's going to be needing the long cycle, and we're not investing enough today to provide the projects for the long cycle needs that the world is going to need to make sure oil supply keeps up with demand 2018, 2019, 2020.
Thanks. Ian Niebuhr with Ernst Energy Group. Question for you guys. You've talked a little bit, John, especially about the improvement in efficiency, how you brought down Bakken well cost from north of 10 million to 5. I'm just curious to know, in your guys' experience, how much further do we have to go? You know, in Argentina, how much further can it go? What inning are we in for the efficiency gains in that type of play?
Well, I think in the U.S., and let Ali talk his perspective for his company, especially in Argentina, you know, this continuous improvement goes on. And it's not just the cost side of the equation, it's also the productivity side of the equation, meaning for the same dollar you get more. And let me give you an example in the Bakken. In the Bakken, we used to frack on 10,000 feet, 35 stages. And we kept experimenting, and then all of a sudden we found we could contact the rock in 50 stages. So you have 50 contact points instead of 35. But we're doing it for the same $5 million that I talked about. And as a consequence, the estimated ultimate recovery from the well, we found went up about 7%. So our recovery went up, our IP, our initial production went up, and we did it for the same cost. So I think you're going to continue to see innovations like that. Andrew was talking before about the idea of secondary or tertiary recovery on shale, where shale right now is maybe 7% recovery. The industry's not going to be content at that. That may be a new innovation that comes up on the productivity side. So I think there's a lot more to be learned about shale. I still think we're in the early innings, and I think continuous improvement will make us ingenious to find more ways to do with less and get more for it.
First of all, there is no shortage of resources worldwide. I mean, that if you look at it, there's deep water, heavy oil, and other. Therefore, every asset got to compete for capital, especially these days. Regarding Argentina, Argentina is in the right trajectory to be competitive on those three parameters with what we see in the United States. Ultimate recovery, initial production, and cost per barrel. They are not there today. To get there, there is other thing rather than Mother Nature got to help us out. Number one is we got to build infrastructure. We got to build the infrastructure that we can basically create the efficiency that John is talking about. We don't have that efficiency. We need productivity. We need human resources productivity. That is a very critical part. There's no criticism. That productivity is not in Argentina. The number of the people got to work on the frac unit in Argentina is much larger than the number of the people that it is in the United States. That cost gone up. Today, we manage working with YPF, lower the cost to the level that we think is sustainable for a period of time, but it's not competitive. Therefore, when I go ask our corporation for money, today they got to decide. There is unconventional in Argentina, give us a return of X, and there is a unconventional in the United States that give a better return. Where do you think the CapEx is going to go? It's going to go that direction. That's the environment we are. Now, if there is a high prices, then you deal with a different parameter. What is it? Production growth. Everybody at the high price chase the production growth. Therefore, you're saying that's okay. They are not competitive, but they give me the incremental production I need. I need the growth in the cash flow and earnings. But in this environment, some of these unconventional got to be competitive with the United States. Otherwise, they won't get the funding.
Thank you, guys.